Tell us whether you're risk on or risk off at this moment.
I think if you look at my market, we've seen 20 plus billion of equity inflows over the last month. We've got the VIX at 13 right now. So we're definitely in risk on mode. I think a lot of people know we priced the ARM IPO last night, $5 billion transaction. We were one of 4 active book runners in that deal. And it was, double digit plus times oversubscribed. So investors are getting a nice return, I think, for the IPO market to continue to open and allow a wider range of companies to come through the door. It's got to be based on returns in the aftermarket. So it's great to see that trading very well. But what I think is as encouraging as that deal is a couple of the deals that we were involved with the last couple of nights, a deal for Silverbow Resources in the energy space, which announced several weeks back an asset acquisition out of Chesapeake. And one of the things that we've seen in some of the recent energy trades has been that the book has been very much hedge fund driven because these deals have come at a mid to high single digit, sometimes low double digit discount. And it's a very easy hedge fund trade for people to pile in, buy at the transaction and sell it back into the market the next day. And what was encouraging to me about this transaction is that we did see some very strong fundamental long-only buyers. The top order in the book was a top 5 fundamental account. And those are the names that we really need to come into those deals to allow the energy companies to do bigger transactions. The deals that we've seen have been $150 to $200 million, but for those bigger M&A driven, $300, $500, $750 million transactions that we saw several years back, we really need the fundamental buyers to come into the market. And that deal was upsized by a third, as was another real estate deal that we were in last night for Essential Properties, a price this morning, one of only 8 REITs to price a follow-on this year. But again, encouraging that we saw enough demand there to be aggressive in terms of upsizing the deal. So again, in my market, we're definitely risk on right now.
Talk to us about the convert market, where it is, where do you think it's going?
Now, look, I think because of all the capital that's flown into the product, that remains a very viable alternative for people as they're thinking about short-term financing needs in a higher for longer rate environment. Year to date, we've seen about 40 billion of converts, whereas last year we had 25 billion the entire year. As Moshe mentioned, we've seen a lot of IG activity in utilities, a little bit in real estate, about $12 billion of issuance we've seen in the IG space. And the level of dialogue that we've had with IG issuers around the product is more than I can remember in years. And look, the reality is with cheap money for a decade plus, there was no need for anyone to risk dilution, particularly IG names, when they could borrow where they could borrow. But obviously with the rates where they are right now, that spread has widened out considerably given that embedded option value in the convertible. But it's interesting what people forget, again, like we hadn't seen a utility deal in the convertible bond space for 15 years. In the REIT space, it had been 10 years. But if you go back before the global financial crisis, at one point, half of the S&P 500 actually had convertibles as part of their capital structure. So it's a tried and true product. And I think what you're going to see right now over the next 12 to 24 months, and maybe 24 months is stretching it a bit, but I think there's still a big opportunity for IG names to use the convertible bond to manage their short-term interest rate costs, but more importantly, manage their short-term EPS. And if you look at the utility sector, for example, which has mid to high single-digit EPS growth, being able to change your cost of debt funding over a period of 3 years, and most of the utility converts that we've seen have been 3-year deals, by lowering the cost of those rates over a period of 3 years, that actually has a big impact on their EPS and what they've told their equity investors. So I think we'll continue to see that, and we'll continue to see other companies start to look at this as a viable alternative as they think about that next maturity stack as we get into 2024.